Let's take a look at the U.S. markets as we get ready for our second big week of earnings. Joining us this morning, Rady of Rady Asset Management, also John Sylvia of Wachovia. And Harry, let me ask you this. Right now we're talking about those markets up over 7% last week on the earnings. Was this entirely because the outlook and because the numbers were better than we had expected?
Yeah, but I think it's low-quality earnings. You know, the earnings are being driven by cost cutting, and I think it's just more of that less worse. And so in the short term, we think that maybe this rally has a little more to go, but it's hard to understand how we can see much more than up a little more. With unemployment continuing to tick up, with house prices continuing to decline, with the government with their tax and spend policy, it's very difficult to see how this market goes much higher. Now, that said, as a long-short manager, this volatility and this uncertainty has created extraordinary opportunities. So we're excited.
John, did what you heard from companies last week do anything to make you feel better about the second half of this year?
Oh, yeah. I think we do have an economic recovery the second half of the year, and we'll see that when the leading economic indicator numbers come out later this morning. They'll be up for the third month in a row. I think the challenge, Becky, for the marketplace, though, is what is the pace of economic growth, which we think is only going to be 1.5% to 2% in the second half of the year. And the second part is you're not going to get any jobs with that. So there's a real challenge there for the market, and I think the exit strategy for Bernanke.
And John, what about this entire idea of what the government's doing right now? It's going to be a focus that people are looking at. We've been talking about it already with some of these major social programs. Are you concerned that that will eat into productivity, or do you think that this is the right direction?
No, I think this is the great challenge. On the macro level, we talk about economic stimulus and spending a lot of money and everything else with the Fed being easing. But on the micro level, we have a lot of regulation, a lot of discussion about health care, energy, the environment. All of that really is offsetting a lot of what we would like to see in terms of job growth. You can't raise the cost of capital, raise the cost of labor, and still expect the economy to grow as it did before.
What do you want to hear from Bernanke when he starts speaking over the next couple of days?
Well, I think, again, some reassurance that the economy is picking up a little bit. They're staying in the game. It really is too early for an exit strategy. Inflation stays pretty low.
Harry, what do you do if you're concerned that these gains that we've seen cannot be extended by a whole heck of a lot in the near term? What do you do to kind of bunker down and make sure that you're defending yourself and your positions?
We're a long-biased, long-short manager. So, historically, we keep a long bias. In this environment, we're market neutral to short bias. But, again, that said, there's opportunity on the long side. We're long stocks like Fleur Systems, trading at 12 times earnings, growing at 20%. We like some of the drug and biotech stocks. We like Cephalon, Endo Pharmaceuticals, Myriad Genetics, and King. On the short sides, we're short stocks like AutoNation. We're short stocks like Big Five, Pool Corp. Sort of these...
a lot of consumer names that you're...
These second-tier consumer discretionary names. So, as I said, we're concerned about the macro backdrop, but this volatility is creating extraordinary opportunity, and we're really excited.
All right, Harry, John, we want to thank you both for joining us this morning. It's good talking to both of you.
Thanks for having me.
Where were you?
You had to be the one who read this.
Yes.